straight to the floor today with that. We have our traders, Scott Redler and Thomas Hayes, joining us. Scott, welcome. I want to begin with you. The R word. I mean, you got the VIX at 27. Are we really worried about recession, or are we talking ourselves into one?
It all depends where you sit, and it all depends your time frame. Like you said before, we are in the definition of a recession, but in some places it just doesn't feel like it. Right now we're going through a valuation contraction because of the excess liquidity provided by the Fed over the past decade. So as we've done, all we've done right now is do what the Fed wanted to do and bring down asset prices, bring down the PE ratio of the S&P, bring down high growth names, bring down every sector in the market. So this way, people feel a little less wealthy, and this way, people spend a little less money, so the demand's not there and prices can come down, so it could help ward off inflation. So I think what traders and investors are looking to see, how long does this last, and what's the next level of this? Does housing prices really come down? Like right now, all they've done is stop going up, and mortgage applications were reduced. They're not flipping houses right now, and they're not overbidding. So right now they're trying to get housing prices down. Oil actually cracked a bit, which is good. I think overall that would be really good for the equity markets. And the consumer is just starting to spend less and feel a little less wealthy. So at this point, the recession doesn't feel, I would say, that strong or that devastating yet. If we were to continue this process and the Fed raises rates more than 75 basis points and then a little bit in September, I feel like, yes, then maybe we have a harder landing, a last long, and then we start to feel it because you get the next leg of it. Right now, they're just squeezing out the excess, and the Fed's doing exactly what it wanted to do.
And it's working a little bit. You mentioned oil, but I can add lumber, I can add copper to that. Commodities have come down in a big way. Citi says, okay, yeah, Tom, this technically could be a recession by definition, but you don't really have a significant recession, or maybe you do, but you usually don't when you have unemployment so low. Friday brings the June jobs report. We get the JOLTS number. We get economic indicators this week. What do you make of things here, Tom? Do you agree with Citi?
Well, I think, Lauren, you mentioned the two key things. We inverted the yield curve in March, and we may now have 2 consecutive quarters of negative GDP. So we may have already had a mild recession in the first half of the year. That's the bad news. But this could be the best thing that happens for finding a bottom in the stock market. The stock market always bottoms before they announce the official recession retroactively. A lot of bad news is priced in already. We saw the first half of this year down quite a bit. Usually when that happens, over 20%. The second half of the year, the last 5 times over the last 100 years, was up 23.6%. So the answer is I wouldn't be shorting in the hole. Expectations are very low, and any unexpected positive news, whether it's inflation, whether it's geopolitical, whether it's earnings, could in fact spark a summer rally that very few people are positioned for. The time to get bearish, Lauren, is when everyone is calm. Right now, people are hidden under bunkers. So I want to be looking for opportunity and know that when that official recession is announced, which could be as early as the end of July, the market will have bottomed well beforehand.
So I think you're saying, Tom, that we're kind of in and almost done with the recession, and the back half of the year that we're currently in looks pretty positive?
Yeah, people are really worried about earnings, Lauren, but the fact of the matter is earnings continue to hold up. Over $250 for next year, which means we're trading at just 15 times next year's earnings. That's well below average.
Let me get Scott in here because July brings so much data. I mean, starting this week, you get the minutes from the Fed's last meeting. As I said earlier, we get the June jobs report. End of the month, we get earnings from like the big tech names, including Microsoft and Alphabet. I mean, Scott, do you think earnings are going to start to price in the fact that we might be in or close to being in recession?
Well, I think what we're going to see from earnings on whether or not they brought down the multiples enough. When companies come out and if they miss and they pre-announce and the stock doesn't go down, then the market's telling you it already did its job, discounting ahead of the earnings. So what I think Tom said is correct, is that at this point, I'm not, a lot of people want to correlate to a baseball game. We're probably in like the 7th inning of this cycle of downside action, maybe through the recession. I don't think the recession, you can't declare it over until it's declared started. We could have another 3 to 6 months of catch up by unemployment, by people starting to lay people off. Like you just said before, you don't really have a recession when there's 8 million jobs open not 8 million people looking for jobs. That's what happened in 2007, 2008. Everyone knew 4 or 5 people that were laid off. I really don't know many, and we haven't heard those stories. There are actually 5 different types of jobs open within 2 miles, and I live in Milburn Short Hills, looking for skilled workers and unskilled workers, and they're having a hard time.
Yeah.
So the question is, will that start to happen over the next 1 to 3 months? And that's if we wind up going further down this road. But at this point, with the S&P off 22% off the highs and some high growth areas 70 to 80%, it's not the time to sell. It's the time to think about, how you could, in a risk-averse way or in a calculated way, put more money to work for the longer term. And as a trader like me, this was a great day. We came in this morning, oil was down, energy stocks starting to get hit. Money started to rotate towards tech. You saw ARK go green with its Cathie Wood. So it started to tell you that maybe some money's flowing into some of the hardest hit areas. And then sectors like the energy or oil take a little bit of a corrective phase, and that helps even things out.
The first half's best performer, energy, the worst performer as we're entering the second half. Scott Redler, Thomas Hayes, thank you so much for the time.
Thanks, Lauren.
Yeah. And American